Everyone's talking about rising rents, and most people are taking that as a signal that the property market is strong. And that's a mistake, because rising rents don't always mean a strong market. Sometimes they're a sign that something underneath is breaking. Here's what most people don't realize. Right now, we've got three things happening at the same time. Rents are going up, inflation is still too high, and buyers are starting to hesitate. That combination is not normal. And if you don't understand it, you'll read the market completely wrong. Most buyers think in simple terms. Rents are rising, so demand must be strong. Demand is strong, so prices will go up. But if you actually look at the data, that's not how this cycle works. Let's break this down properly. Let's start with rents. Vacancy rates across most capital cities are extremely low, like under 1%. That's not tight, that's record levels. And yes, when vacancy drops, rents rise. That part is straightforward. But here's the part most people miss. We've had low vacancy rates for a while without rents moving much. And now suddenly rents are rising again. So what's changed? It's not just demand, it's supply. No meaningful increase in new housing. Construction costs are still rising and new projects aren't coming online fast enough. So what you're seeing now is pressure building. And when supply is constrained, prices don't just rise, they accelerate. But here's where you need to think differently. Rising rents don't mean tenants are doing well. They mean tenants are under pressure, and tenants have a limit. They can't just keep absorbing high costs forever. At some point, they adjust. They move further out, they share accommodation, or they leave the rental market altogether. Which brings us to the second layer, first home buyers. When rents rise aggressively, some renters don't upgrade, they exit, they try to buy, not because they're ready, but because renting becomes too expensive. Here's what most people don't realize. That creates forced demand, and forced demand is risky because those buyers often stretch their borrowing, use smaller deposits, and buy earlier than they should. That's not strong demand, that's pressure being transferred from renting into buying. Now layer in the third factor, interest rates. Inflation is still above target range, energy costs are rising, global pressures are feeding into the system, which means there's still a real chance rates go higher. Now think about what that does. Higher rates reduce borrowing capacity, less borrowing capacity means less purchasing power, so now you've got rents going up, buyers stretch to enter the market, and borrowing power shrinking at the same time. That's not a stable setup, and you can already see it in buyer behavior. Auction clearance rates are starting to ease, not collapse, but soften, and that tells you something important. Buyers aren't becoming cautious. Here's what most people get wrong. They think markets turn when prices fall. They don't. They turn when confidence shifts, and the confidence is already shifting. Now here's the move edge. Most people look at rising rents and think this is a good time to invest. We'll look deeper. We ask, is this demand sustainable? Or is it driven by supply constraints? Because those are two very different things. If demand is income driven, it's healthy. If it's supply driven, that's fragile. We also look at who's entering the market. Are these buyers well capitalized or are they stretched? Because markets driven by strong buyers behave one way. Markets driven by stretched buyers behave very differently under pressure. Another thing most people miss, this is not one market. Sydney is reacting differently to Melbourne. Different segments within each city are behaving differently again. So when you hear the market is doing this, you have to ask, which part, which buyer, which price point? Because averages hide risk. And that's where most people get caught. So what you should actually do with this, 1, don't chase rent growth blindly. Rising rents are not a green light. They're a signal to look deeper. 2, understand the driver. Is this growth coming from strong rent fundamentals or from constrained supply? 3, stress test your decision. If rates rise again, if borrowing capacity drops, if demand softens, does this property still make sense? If the answer is no, you're taking on too much risk. And finally, focus on structure, not noise. Headlines will tell you rents are rising, markets are tight, opportunities are everywhere. But structure tells you supply is broken, buyers are stretching, and pressure is building underneath. So here's the key idea. This market isn't sending one signal, it's sending conflicting signals. And if you only listen to the obvious ones, you'll miss what actually matters. The advantage goes to the buyer who understands what's happening beneath the surface, because that's how you make better decisions, with clarity, not guesswork.